Alright, this is the educational part of the Bookmap introductory course, and the introductory topics will now be concluded. And in this session, we're going to give you 3 indicators: the absorption indicator, the liquidity tracker indicator, and the sweep indicator. Friends, there's something I wanted to share with you. It's about the breaks I used to take between the training sessions, and you would always complain saying, "Hey, upload sooner," and all your complaints. I heard them all, and I put up with them this whole time, and honestly, I accepted them from you, But there was only one reason for it, and that was to get your feedback and incorporate that feedback into this course. So for this course, I did have a set of topics planned to teach you, but in each session I would pause to get some feedback from you to see if I should add certain things to the next sessions or not. Of course, I'm aware of everything, but users have some hidden perspectives, and there are things that users might not know. Things that might be trivial to me might be something that isn't clear to the user. As a result, it was necessary for me to leave this gap so that I could somehow incorporate that feedback into the course as well. So this course, in addition to what I originally intended to teach, has also incorporated your feedback. For example, in this session, I'm going to address one of the pieces of feedback you gave me, which is that in the previous session, you had trouble understanding what those small numbers shown in the iceberg actually represent, and that visually it doesn't look like an iceberg at all. So I realized I needed to clarify this for you in this session, which relates to the HFT topics you can also see on the screen. So let's get into explaining these, provide the indicator, and hopefully wrap up the final session. Read this part. It says that it's easy to imagine that some high-frequency traders, HFTs, decide to mimic the behavior of iceberg orders using regular limit orders. So what does that mean? Look, we have a group of high-frequency traders who imitate the behavior of iceberg orders by placing regular limit orders. They send a relatively small order, similar to the displayed size of an iceberg order, the display size, and then each time the previous order is executed, they send another order. The only drawback of this method is the time delay, which requires complex algorithms and high-speed internet. Look, friends, iceberg orders submit their entire order and leave it to the CME to place it as an iceberg. But these high-frequency traders, in order to reload and simulate iceberg-like behavior, they do the reloading themselves. And this self-reloading requires complex algorithms and high internet speed on their part, because it's them who are doing the reloading themselves. It's not the CMA placing the orders anymore, so that's the difference here. The effect of these simulated orders on price is like iceberg orders. They act exactly like icebergs. In HFTs, the display size can be increased or decreased. Look, regarding your question about whether the display size can change or not, for icebergs, no, it's fixed. But HFTs can adjust their display size up or down depending on their objectives. However, the thing is, HFTs, unlike icebergs, don't have that much money. Their capital is smaller. The big players in the market are the icebergs. HFTs don't have that kind of money. As a result, they try first and foremost to identify the icebergs so they can follow behind them. And because they have less capital, they try to quickly exit their positions as soon as the market moves even a little bit. But this move of theirs disrupts the iceberg's operations. Let me explain it to you. Look, at this price level you see here, an iceberg order is detected, and essentially it defends against the price dropping below that level with the goal of, for example, pushing the market upward. The HFT identifies this and immediately enters right after it. What disruption does this cause? When the iceberg raises prices, this HFT with limited funds seeks a quick trade to exit immediately. As a result, after a few ticks when the price goes higher, it starts to do what? Take profit and exit. This very action causes the price to drop, and this price drop is not suitable for this iceberg. It disrupts the iceberg's work. That's why icebergs don't like HFTs, shameless clown. So what do? If you notice, some icebergs no longer start defending at that same price tick. First, they let the market detect them, and then they don't defend much. They let go and, for example, start again a few ticks lower, maybe 1 or 2 ticks down. They defend again, then let go and start defending 1 or 2 ticks lower. See how they defend across several ticks? This move of theirs caused the market to drop by this much, and the high-frequency trader, or HFT, that entered at this point takes a loss here and exits the position at a loss. Once it is out, the iceberg order is relieved and then pushes the price and the market upward in the direction that it intends to go. In the next slide, we see that by comparing a real iceberg order with an iceberg order simulated by HFTs, that is, high-frequency traders, it becomes clear that the impact of such orders is almost identical. Even if the time intervals for placing HFT orders are longer than those for iceberg orders, as mentioned before, and as you can see here, the impact of iceberg orders and HFTs is completely similar. The only difference is that the time intervals for HFT order placement are a bit longer than for iceberg orders because the CME is placing the iceberg orders, but the HFT is doing it itself based on its own algorithm and essentially its high internet speed. I really want you to read this line carefully. It says, it also becomes clear that iceberg orders and all their similarities with HFT act as a magnet for aggressive orders. Before providing the absorption indicator, let's clarify that our previous topics are all subcategories of absorption. Whether an iceberg order, an HFT, or a heavy limit order defends against an aggressive seller, they are all essentially absorbing the selling pressure. Note that heavy limit orders preventing price drops aren't always defensive, which I will explain later. But anyway, it results in defending against the price dropping. What is it doing? It's absorbing. So all three of these are sub-branches of absorption, whether it's an iceberg, HFT, or limit regular orders, which are the liquidities within the order book. Next slide, iceberg orders versus regular limit orders. I want you to pay close attention here and let's do a quick flashback together. Look, it says that just like iceberg orders, regular limit orders can also behave this way. How? By responding to market actions, by adding more liquidity on the opposite side. So look, in the area of asks and bids, well, there have been some orders. An aggressive seller comes in and starts hitting the bid, consuming the passive bid orders. You can see that the order book becomes less dense. In response, more limit orders are placed, but these could just be regular limit orders. However, the response looks similar to icebergs. Guys, flashback to the section, if I'm not mistaken, on iceberg algorithms, where I talked about underflow and resistance. We said there that when limit orders fill quickly in algorithms, whether underflow or resistance, we said these might be responses from other clients. They could just be other market participants, not icebergs placing orders, but regular limit orders, if you recall. I said exactly that, and it's saying the same thing here, saying that responding to market actions by adding more liquidity on the opposite side is similar to icebergs. But these are just regular limit orders. They're not iceberg orders. That's why we said those two indicators, underflow and resistance, aren't useful for us, and that's why we gave you the MBO indicator so you can specifically identify those iceberg orders. But friends, I really want you to pay close attention to this point. Those limit orders aren't placed to defend the price. Friends, look, the purpose of an iceberg order is defense. It's placed with a specific goal to defend and prevent the price from dropping further with the intention of, for example, reversing the market or moving the price in the direction they want. But limit orders aren't like that. They're just the liquidity being observed within the order book. First of all, these specific limit orders can essentially represent the order of a trader, an individual participant who wants to buy or sell something at their exact preferred price point right there. And that is it. They simply leave the market. That's it. There's really no other intention here, okay? So that's just one use for limit orders. What else could they possibly be used for? An iceberg exit. For example, say this iceberg order bought down here, defended the price, and purchased from these sellers. Well, what should it do up here? Up here, it has to sell its orders as limit orders. Consequently, you'll see some absorptions happening at higher levels. And that iceberg, say the price is here, and the iceberg acted here, suddenly you notice that up there some limit orders have been placed even before the price gets close to them, and this can serve as a signal for you that, hey, that iceberg order is about to start unloading and taking profits over several price ticks. Also, keep in mind that icebergs usually don't exit all at once, just as they don't enter all at once. Market participants and traders usually have to offload these large positions in several different price ticks because, as they are moving the market up, in order to effectively protect against the price dropping further and to carefully guide the price higher, they sometimes even need to utilize iceberg orders in the middle of the move. As a direct result of this complex process, they are forced to unload these assets in several distinct price steps to maintain stability. But let's move on to see exactly what differences these two have in this table, and let's review some of their differences together. Here it says that both iceberg orders and large limit orders can influence the market in two opposite ways, by absorbing aggressive orders and reversing the price trend, which, as we mentioned, doesn't necessarily always happen this way. Large traders and iceberg orders both drive price movement by creating significant market absorption. Do icebergs attract large traders who are seeking liquidity? Yes, regular limit orders do too. Number of orders? Very few. About icebergs. How many iceberg orders do we actually see? Well, very few, guys. If your indicator is showing a lot, that's because of HFTs. Real icebergs are rare. But with regular limit orders, you can basically see all the orders in your market depth. It asks, when are they visible? When do they show up? Well, regular limit orders are visible whenever they're placed at any price level. However, the situation is fundamentally different when we consider the unique behavior of iceberg. As we have thoroughly discussed together across our previous three-part series, this particular element only truly becomes visible and officially recognized by the system at the specific moment when its display size is executed for the very first time. It is important to understand that when it is run for that initial time, that is the exact point in the process when it actually transitions to being visible and is finally recognized by the underlying architecture. Otherwise, no, it's not visible. It says total order size is visible, but regarding iceberg orders, no, as the name suggests, it's an iceberg. The total amount that's supposed to be in the iceberg is never visible to anyone. But for regular limit orders, naturally, yes, whatever it is, whatever is placed in the order book, we can see full execution. For full execution, naturally, when a regular limit order is fully executed, well, we see it. But for the iceberg, it says here, not until the execution of all orders at the price level. It means not until the full execution at that price level for all the orders that the iceberg is going to place is completed. In other words, all orders at that price level must be executed so we can understand that the execution was complete, it was full, otherwise we can't really tell. Regarding cancellation, well, for a limit order, when it's placed and then removed, we see it. But for an iceberg order, it's yes after detection. See, as I mentioned, first of all, the display size of the iceberg must occur once to be identified. Then, after it's identified, if that display size, the display size our indicator has identified, I'm getting tongue-tied, sorry. If that display size identified by our indicator is then removed, well, it knows that's why it displays the letter C for you. We talked about this in the previous session that our indicator shows cancellation with the letter C. But until it has been identified naturally, if a display size that hasn't been activated or identified yet is placed and then removed, we obviously won't know whether it was an iceberg or not. So, yes, after detection, after it's identified, being used for manipulation. For manipulation, it means essentially deceiving, somehow manipulating or cheating. It refers to what do they call it? The advertising they do in the market to create a sort of manipulated state in the market. And for example, for instance, when you see a heavy limit order being placed in Bookmap, even though the price is low, they place a heavy limit order way up there. That's exactly the manipulation part, the part about enticing, making the market look more attractive to suggest that the market is going to go up. Naturally, in regular limit orders, yes, they are enticing with that very limit order they place. But for icebergs, the absorption indicator that we're going to give you this session says, the absorption indicator is on chart, identifying areas where high volume is traded over short periods. Absorption is the result of aggressive buyers or sellers' activity at key levels, which you all know by now. Essentially, it shows where large sell limit orders, which are sometimes iceberg orders, absorb large buying aggressors and vice versa, where large buy limit orders absorb large selling aggressors. In many cases, absorption indicates areas where price bounces and moves in a new direction. Alright guys, to add the absorption indicator, just go to the configure section and click on add. Go into that FOMO trade indicators folder that you used when you wanted to install Bookmap, which you downloaded from our Telegram. Go in there and import this absorption indicator version 2.49. Check this radio button, click load, and also check this box so that it loads onto your chart. As you know, this indicator is shown directly on the chart, and it clearly displays the absorption happening right there on the chart. These red ones represent passive sellers, while the green ones indicate passive buyers. Now, as for the settings we have here for our chosen instrument, guys, is divided into two parts. One part relates to volume, or the volume we want to see. Right now it's 100, but for example, look guys, we need to have a filter. If we set it to 1, well, the whole market is absorption, and naturally it becomes a chaotic mess, which isn't what we're looking for. As a start, as a basic setting, you can set the volume to 100. And the second part that affects the settings is the seconds. The seconds, which is actually seconds the traded volume here. Meaning the seconds in which our desired volume was traded is what's considered. You can set it to 1. This setting here is a basic one that can be suitable for starting out. It's not ineffective. It can be used, but guys, for every instrument, you must adjust this according to your intended strategy and what you're looking for. I won't give any other suggestions because it's a personal thing and varies from trader to trader. A trader wants to see absorption, but it's important to them what amount of absorption they see, at what volume, and at what speed. And it's important to them how quickly that absorption happened. So these are personal strategies, and it also varies from instrument to instrument, meaning we have one setting for one instrument and another setting for a different instrument. And as I said, you can also change this second, for example, to 1/100th of a second. When you click apply, it takes a little while to process, and you'll see that it becomes a bit less. Those absorbs that were on the chart in the 1 second mode. These, well, were the ones where absorption happened much more quickly. As I said, for starters, you can just set it to 1 for now. And, well, it's kind of a world of exploring and experimenting. And it varies from instrument to instrument. You can use the automatic mode option, which when you click it, Bookmap itself basically applies a filter. I don't recommend using automatic mode, but in any case, you can see what the suggestion is for your instrument. But as I said, it's something you need to adjust yourself. The next section is sound alerts, where you can set up a series of alerts. But as I said, it's something you should fine-tune yourself. The next part is sound alerts, where you can set some alerts. The next part is the visual settings, similar to the Iceberg indicator we had. Show icon is for the absorption icon. You can toggle it on or off. There's also show volume, which displays the volume here. You can enable or disable it. The rest are settings like icon size, which you can leave at the default. It has an offset, a gap between where the absorption actually happens and the information it shows us. This offset line also shows us the thickness of that offset. You can remove the trade dot where absorption occurred, but I suggest keeping it visible. You can change its size for when it happens, and whether the style should be rectangular, square, or round. This is a matter of taste and the colors I mentioned. Passive sellers are red, passive buyers are purple. Some call it pink, I don't know. Passive buyers are green, and that's it, nothing special. And for those traders who specifically want to observe market absorption using this technical indicator, they can certainly use it. Furthermore, they can easily adjust the various settings according to their own unique trading strategy and the specific financial instrument they are currently trading in. Let's take a break and then come back to examine the liquidity trackers and sweep indicators together. Alright friends, to add the liquidity tracker indicator, go to Configure and click Add. In the FOMO Trade Indicators folder, open the Liquidity Tracker Pro Indicator version 3.2.4, click on its radio button, load it, version 2.2.2. Check this box as well to add it to your Bookmap platform. The thing is, this indicator isn't on chart, it's a subchart. Meaning you have to bring this up so it shows as a subchart here. And this is what we have in this indicator. If it looks cluttered when you open it, it's because extra options are enabled here. For example, your CVD might be on or other things. Please turn those off and only keep these 3 specific options, which are directly related to these settings, turned on so that you can use this indicator. Alright, now let's carefully examine our indicator. Let's bring up its settings so I can explain it better to you. See, this green line relates to the bids, and it shows the total sum for you right here. Now, the orders on the bid side, here, this red line represents the ask orders, and here it also shows the sum of orders on the ask side, and this white line is the difference, meaning the gap between these two. The higher this is, the more positive it is, essentially towards the upside. What is it actually saying? It says that these bids are more numerous than the asks. So naturally, the orders below the price are heavier than the orders above the price. And if you go lower, watch how this price becomes more negative. Now, look at this description that's opened. For example, it's now minus 355. What was it here? Minus 278. As this gets more negative, what's it saying? Look at the chart here. This bid price this ask count increased. Naturally, this difference has moved lower. So, the further this goes down, it means that in the direction above my hand, in the direction of my asks, the number is increasing. The number of orders is getting higher. It's getting heavier. This is how we use it. In its settings, there's a uniform mode and a weighted mode. We generally don't use the uniform mode because it's not useful for us. For example, look right here. The price has gone up and reached this area, and the same thing has happened here. This line doesn't help us. The main point is the discussion about weighted sum with half-life rate. Its default setting is 10, and I also recommend leaving it at 10. What it does is it considers the 10 price levels closest to the current price, and it does this using a half-life method. That means the higher the price level, the further it is from the current price and the less important it becomes. In this way, it calculates for us, essentially giving more weight to the centralized order book in its calculations, which helps us, for example. Here, as you can see, the white line has started to drop. It's telling us that this upside has actually started to get heavier, and this increasing weight against the rising price has given us this warning that, look, the upside is about to create a sort of imbalance that will stop the price, which, as you can see, is exactly what happened. We use this indicator in this way. These three options here are technical modes that you can add to the calculations. Anyone can use them according to their own strategy if needed. This section is for filtering order sizes, which you can also use if you need it for your own strategy. These are color settings. You can change them, but why bother? Just leave them on default. And the settings for these were the ones I mentioned. Alright friends, to add the sweep indicator, go to the configure section and click on add. In the FOMO trade indicators folder, double click on the sweep indicator version 1.19, click the radio button, load it, and check the box so it loads for you. This indicator is on chart, meaning it appears on the chart. Now see, it's loaded here for you like this, telling you in this area that, hey, a sweep has occurred right here. Let's go over its settings first, and then we'll talk a bit about how to actually use it, what you can do with it, and so on. Look, this indicator has three parts for configuration. One part is the seconds, which is the time when our desired volume is traded. Another part relates to the volume we want to monitor, meaning from which volume onward we want to see. And it also has a minimum price level, like show us this many price levels and above, meaning if it was less than 4, not 4 price levels, but less, for example, don't show it to us. So it consists of three parts. The basic recommended setting, meaning this setting isn't for use on all instruments or for every condition. To start, for basic, what you can use is this setting that you see right here. For seconds, 0.1. For volume, 100, and for minimum price level, 4 is fine to set. It has an automatic mode section that, when turned on, checks an automatic setting for you. You can use this or not. My suggestion is always to adjust the instrument to your preferred settings, and in any case, if you use this automatic mode, don't change these settings, just leave them as they are. It has sound alerts, like other indicators, so you can set alerts for it. I won't go over the obvious things again. I've already explained what icon size is, what icon offset is, and thickness is the same. These are all appearance settings. As for this dot, you can see its value is currently set to round, but you can set it to rectangle to make it square, or keep it on round. You can adjust all of these along with their colors. Pay attention here, aggressive buyer, aggressive seller. This indicator is about sweep, and it generally discusses aggressives. The sweep indicator is the opposite of the absorption indicator. Absorption works with passive players, while sweep works with aggressors. These two are opposites, meaning the sweep works on the aggressor side, while absorption works on the passive side. And it's great when both of these indicators give you a signal in the same direction. I'll show you an example of that later and give you a quick overview. As for the settings, we mentioned that when the seller aggressor comes in and hits consuming the contracts, it sweeps the order book like this. Now, this sweeping of the order book can happen in one scenario where the aggressor actually comes in and quickly consumes the orders here. In another scenario, there are so few or no orders that basically it's like a vacuum. So with the very first lots from the aggressor, the price is quickly swept downward. Guys, when we're using the sweep indicator, we don't want to see the cases where the sweep happened just because there were no orders in the order book. In fact, what we really want to see are the situations where the aggressor pushed hard, took out the orders, and caused the sweep so that the aggressor's strength stands out to us. When we see the sweep alert on our indicator, it should tell us that in that brief second, like I said, you could set it to 0.1 to start with. In that short moment, our aggressor executed a sweep, and not just any sweep, but one where the order book was full and the aggressor forcefully swept through it. That's what we're after. In this indicator, and if I want to give you a bit of a hint about how to use it, let me show you an example right here. I hope you can see it. For instance, right here, a sweep has happened, 250, and the aggressors were buyers who swept. Here, the buyer aggressors were 277, and here, 1,218 buyer aggressors. So, if I want to give you a clue about how to use this indicator as a whole, of course, I know, unfortunately, every time you make me more disappointed than before. When it arrives and you send it to me, what settings should I use? What should I do here? How do I use it? Using and setting these configurations, all of it, ultimately depends on you, your own personal strategy, and your own knowledge. I shouldn't be the one telling you for this instrument here or there, on this indicator or that indicator, to use this or that setting. You choose the setting based on what you want to see. Honestly, sometimes you disappoint me. But for now, just to give you a hint, I'll tell you how, for example, you can use it. I'm talking to beginners here. Look, right now we have our absorption indicator turned on. Turn on liquidity as well. The sweep is already on, so turn on liquidity too, and let me turn on absorption as well and let it load on the chart. Okay, now let me open liquidity too. Look, what do I see here? I see that a sweep has occurred. These round dots, basically the green ones you see, are from the sweep, right? This swipe was done here. How many do I have? 1,218. What am I seeing here? When this went up, this one came down in the liquidity tracker. What is this telling me? It's telling me that in this area, basically, the number of these upper level orders has been increasing. But what did our aggressor do? Our aggressor came, and even though these were increasing, swept them away. Well, here it shows us that we have a strong aggressor who, considering the heavy imbalance up here, has come in and executed this heavy sweep, which was as much as 1,218. Immediately, our absorption indicator also tells us what? He says, look, when the aggressor seller comes in to push the price down, here it gets absorbed, that's that. And from this point on, you can see in the liquidity tracker that our white line starts moving upward. This means it's telling us that basically our passive orders at 10 price levels, as I mentioned, this is looking at 10 price levels, and it's using a half-weighted half-life method to analyze them. So the further away they are, the less important they become. The closer they are, the more significant they are. What is this telling us? The fact that it's going higher is telling me that, look, there's an imbalance forming in the direction of the bids. What does that mean? It means that below the price, the number of orders is increasing, meaning this price is being supported from below. So, as you can see, 3 indicators here are giving signals in the same direction. Our sweep is from this side. Our liquidity tracker is indicating that passive buyers below the price are providing support. And on this side, we have absorption happening here, which means that absorption has taken in these aggressive sellers. What has it absorbed? It has absorbed passive buyers. These 3 indicators are all giving you upward signals here. Naturally, the logical outcome is that the price moves higher. And when it does move up, you can see in this area that a sell absorption occurs. That is, a passive seller comes in and gets absorbed here, which is the same order that was present here. And at the same time as this absorption happens here, meaning as the price moves up, you see here in my order book, it shows that the imbalance on the upside of the price has started to increase, meaning above the price. So it's giving me this alert that, hey, if you took your long from here to here, the price is stopping now. And as you can see, it did stop. This is how you can use it.